This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And good afternoon, everyone. Happy Friday to you all, live on Bloomberg TV, radio, streaming on YouTube and Bloomberg Originals. I'm Katie Greifeld alongside Bailey Lipschultz. We are in for Carol Massar and Tim Stenovec. It's Friday. It's the final trading day of the month. And 24 hours ago, Bailey, you and I were sitting here. We were looking at all-time highs on the S&P 500. A different picture today.
No more. NASDAQ 100 down more than 1%, but volumes are still light.
Yeah, still light, of course. Things get back to normal on Tuesday of this week, but we have a great show coming up for you on this Friday, August 29th. We start with a mixed consumer picture as the Fed's preferred inflation measure remains sticky. Consumer spending hits a new high. We'll break it all down with Claudia Sahm of New Century Advisors and Jayati Bharadwaj of TD joining to discuss that dollar weakness.
Plus, Katie, we will have the latest out of D.C. as Fed Governor Lisa Cook sues President Trump. Bloomberg's Jordan Fabian has all the details after this morning's emergency court hearing.
And later today, it's day 2 of Bloomberg Businessweek at the U.S. Open. We'll check in with Tim Stenovec and Molly Smith. All of that and more coming up. But first, a check on the day's trade and top business stories. Let's say hello to Charlie Pellet.
Thank you very much, Katie Greifeld. Here's what's going on. Keeping an eye on shares of Kraft Heinz right now. The stock is advancing by 2.3%. Kraft turning positive as the Wall Street Journal says that the company is nearing a breakup announcement. We're monitoring the story. We'll have more details as they become available. But right now, we got Kraft Heinz up by just about 2.3%. The Dow, the S&P, NASDAQ all in the red right now. Traders driving stocks lower amid a sell-off in tech shares. As Bailey mentioned, the NASDAQ 100 index down 1.3%. S&P is lower by 44, down 0.6%, trading at 64.57. Keep in mind, yesterday we had that record close above 6,500. The Dow down 113, down 0.2%. NASDAQ, the composite index, down 1.2%. 10-year at 4.21% with a 2-year 3.62%. Gold up $27 the ounce, up 0.8%, while West Texas Intermediate crude just above $64 a barrel, down 0.9%. A major move to the downside for Bitcoin, 108,362 on Bitcoin. That is a drop right now of just about 3.2%. Dell, after earnings lower, the company booked fewer sales of AI servers than in the previous 3 months. Dell tumbling by 9.6%. Also after earnings, Marvell Technologies results featured a disappointing read on its data center business. Marvell plunging now by 18.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, thank you for that update, Charlie Pellet. Let's get back to one of today's top story, and that is the U.S. consumer still spending even in the face of higher prices. We're joined now by Claudia Sahm. She is chief economist over at New Century Advisors. And Claudia, I mean, the word that I keep hearing to describe the PCE report that we got at 8:30 this morning is sticky. You think about core PCE on an annualized basis coming in at 2.9%. You think about core PCE on a monthly basis at 0.3%. It feels like that 2% target that the Fed wants to get to, it just remains elusive.
Absolutely. You know, we are no longer making progress towards the Fed's 2% target. I mean, earlier in this year, you could still point to some progress. Right now, I say it's more that we've stalled out. And there has been a really robust conversation about tariffs and how this could be a temporary factor. I think that's you do see that in the goods inflation. I think it's going to take a long time for that to work its way out. That'll be a lift to inflation. To me, the part of the PC inflation in July that was really disconcerting was on the services side, and particularly the non-housing core services, what the Fed refers to as super core. We really looked like we were making some progress earlier this year, and it is just not. We're back up at a pace of inflation in those categories. It's just not comfortable, and you know, is not pointed in the right direction. And it's a lot harder there to point to tariffs.
Claudia, not going in the right direction. Is the environment ripe for a rate cut at next month's meeting then?
So I thought Chair Powell did a really good job last Friday at Jackson Hole outlining the risks to the economy. And this is a challenging economic environment. The dual mandate is in tension. There are reasons to expect inflation to go even higher from where it is right now. It's already elevated. And there are reasons to be worried about employment really going lower and having some deterioration in the labor market. And so it is a matter of sifting through every bit of data and trying to get a sense of what that balance of risks is, because there's no path for the Fed that will check both boxes. Like, they are in tension. So I agree with the assessment that, doing maybe an insurance cut in September, kind of trying to stay ahead of the labor market weakness makes sense given where the Fed funds rate is. But I don't see the case to be signaling, like Fed Governor Waller did last night, that we're like lining up a whole sequence of cuts. I have a feeling we're going to be like in this back and forth push and pull of the inflation employment data probably through the end of this year.
Well, you make a great point. I mean, you consider the fact that you have the dual mandate, the two sides in conflict. We haven't been in a dynamic like this in a while, Claudia. And that was going to be my question to you. If we do enter a situation where, okay, you have the labor market weakening, but you have core inflation stuck maybe closer to 3 than it is to 2%. I mean, realistically, how much room does the Federal Reserve have to cut rates? And if they're stuck in a stop and go situation when it comes to rate cuts, I mean, how much are these kind of one-off 25 basis point cuts actually going to matter in this economy?
Right. Well, as Powell mentioned last week, with the unemployment rate as low as it is, and in particular as stable as it's been over the last year, they can proceed carefully, right? So, and a 25 basis point cut at one meeting, maybe we cut again soon, maybe we don't. Like that's what carefully looks like in Fed world, right? Now they absolutely have the space. If things in the labor market were to really start to gain downward momentum, the federal funds rate's above 4%. There's a lot of room to cut. There's a lot of room to respond if they need to, and they'll switch gears. But the data they're not there yet. We're talking about risk. We're not talking about it's happening. And so I think they're in a good place, but my goodness, it is so hard to catch the economy when it's turning. I mean, it could be, we talk a lot about the labor market as a potential turn, but you could have inflation take off. And, like these kind of moments where you're trying to get that right, that's very tough. And, they may get it wrong, but I think that's where like being careful and deliberate is going to be the strategy that works for them.
And Claudia, we have a kind of pretty strong set of data that we're going to get before that September Fed meeting. What are you keeping an eye on? What can kind of vindicate the push to do a quarter point cut in September, or what could actually kind of throw those plans astray?
Right. Well, the logic of the setup for the September cut is more in an insurance space, right? It's about risks. So we've got one inflation print, one employment print. Is that going to like totally change the picture of risk? Probably not. Like the employment report last month was a game changer, but that is a very rare occurrence. And we shouldn't expect getting that kind of like news in one release. So I think, they're on a path to be able to do a cut in September. I fully expect we're going to see dissents. Like this is a tough one. Like I can see reasons to be concerned about on the inflation side. We're going to get stuck at 3%, so I think we'll see some differences of opinion and differences in votes. And that's a healthy thing. And it just underscores like this is a tough environment for them to decide. I think of the two reports, probably the employment report is going to give more kind of signal to what's the right thing to do. In all likelihood, we're going to get another inflation report that's firming up, and they're going to have to be able to make the case we are cutting as inflation is rising. And I think they can, but that is not a typical moment for the Fed to cut.
And of course, all eyes on the Fed at that FOMC meeting next month, not just for the rate decision, but also for the politicized nature of what's going on at the Federal Reserve right now, Claudia. And you think about what's unfolding right now in D.C. We know that Fed Governor Lisa Cook has sued President Trump over his attempt to oust her from her position right now. And Claudia, I mean, we've been discussing with each other what's going on when it comes to this administration, the pressure that it's trying to exert on the central bank. What sticks out to me is the apparent non-reaction that we're seeing in markets right now. I keep hearing that the worst case scenario is we end up in a situation that pressures the long end higher. But Claudia, we're just not seeing that kind of stress come through.
Right. We are in uncharted territory. It is hard for investors, particularly kind of a massive investors, to kind of really see where this could go, right? Like, this is just a level of creativity that maybe financial markets don't typically, and foresight that they don't typically have. I think this is a real risk. What has happened this week with Fed Governor Lisa Cook, to me, that's just the latest in a series of efforts by the White House to gain more control over monetary policy. And they've been very clear what they want if they get more control, and that is ultra low Fed funds rate. And I think at this point, this is something that the Fed itself, when it talks about what are the inflation risks, a Fed that is no longer independent, like, that is in the mix now, and which is just really shocking. But, if control is lost, well, and interest rates go very low, then we are talking about an inflationary episode. And so, if we get there, I fully expect markets to react strongly. But it's just, it's a risk that's out there, and it just still feels maybe to investors like just not possible. But unfortunately, I think it's a real risk, and the risk is rising.
Yeah, Claudia, just quickly here, if that does happen, where do you think investors are going to shift their assets to?
Yeah, I think this will be a very messy adjustment if we get there. And it also, the expectations of inflation taking off, should build in very quickly. But it's, as with the tariffs, it's not like it shows up the next day, right? It's a process. Like, it would, we could have, in the macroeconomic effects of it could be pretty subtle in the beginning. It's more that, in the US and around the world, when politicians take control of monetary policy, on average, usually it goes to a bad place in terms of higher inflation and more financial and economic instability. So exactly what that would look like, I don't know, but I really don't want to see it happen. But, like I said, it's a risk, but I think it's actually, we're at a point now where, like, it's a real risk.
Yeah, a lot of risks to digest. Thank you so much to Claudia Sahm. She is the chief economist for New Century Advisors. Want to pivot to a guest here in studio with us. That is Jayati Bharadwaj, director of FX strategy at TD Securities. Jayati, just to start on that, how does the ongoing Lisa Cook saga impact the haven status of the U.S. dollar and expectations around what that could mean if we lose a truly independent Fed?
I think that's definitely a very important question, because there have been a lot of indications of the increased political interference into the workings of the Fed. And I think the question you asked to the guest before me was also very relevant, like, why haven't markets reacted intermittently to this? I think it's because a lot of the implications of that would be on the path for the 2026 Fed cuts. A lot of the new appointees, which Trump and his advisors can potentially get in, will impact a lot the 2026 path. For now, we are solely focused on the September Fed meeting. Will the Fed cut? How much will that be? Will that be a series of cuts? And that's why market reaction has been relatively contained. But on our end, we are preparing for the worst case. Let's say if this increased interference does proceed, we have actually recently been backtesting what that scenario would mean for the dollar, and it does not look as optimistic.
Well, talk to us a little bit more about that, because that's what I've been asking investors. How do you start to blueprint where this could go? And in the currency market, Bailey asks a good question. Is the dollar still a haven in that worst case scenario?
So when we are actually now laying out the blueprint for what that could be, we're analyzing two scenarios. First of all, it would be definitely linked to more Fed cuts, so front-end rates come down. But what would be more interesting would be also the reaction of long-end rates, because it would either be a bull steepening or a twist steepening kind of a regime. But irrespective of that, thankfully, both of those regimes are very bearish for the dollar. Because in the twist steepening regime, you will have risk premia, accumulated in the long end because of inflation expectations. People thinking that the Fed will have to cut a lot more than what is actually needed for the economy, especially when there are concerns around inflation pass-through. or even if it's not that, like both of them are very bearish for the dollar. And as you correctly mentioned, like a lot of people are asking, is that really a safe haven? That's something that we've been flagging since the start of the year, that the dollar safe haven status is at risk. A lot of people have questioned that, oh, maybe it's just one-off. But that has been true for a good, 8 months of the year, where the dollar's safe haven status has deteriorated and it's not been behaving like one for quite some time.
Well, I was in Japan when we had the tariff tantrum, if you will, and we saw a lot of questions about selling America. And that was a big conversation in Asia. Where do you reallocate assets to if the dollar is not a safe haven, if U.S. Treasuries are not as sturdy as we would like to think? Yeah. Where do investors position in the currency market?
So since the start of the year, there's definitely been repatriation and a reallocation towards the euro area, which started when in February you had the announcement on the local fiscal platform. That has plateaued a little bit. But what you have seen increasing signs of is definitely investors looking for opportunities outside. That's something which has not been true for the last 5 years, where the gap between the US and the rest of the world was so wide that everyone was only investing in the US. I'm not saying that the gap between both of those ends has completely shrunk. The US still has a relative advantage to the rest of the world, you could say, but it's definitely slowed down, whereas the rest of the world is still holding up. So that gap has sharply converged, and that's encouraging people to look elsewhere. Europe has been the first one, but eventually, there are still a lot of countries in other developed markets, Japan, Australia, all of them still look primed for, seeing inflows. Japan saw a bit of uncertainty with the elections and everything, but that's now past us. Similarly, we're all waiting for the trade deal with China to be announced, which will start bringing in capital allocation back to Asia, even Australia, and that should also uplift that region. But that's definitely something which we see playing out, in the next few quarters.
It's interesting because it's a similar story in the equity market as well. Investors have been looking outside just the U.S. option. We know that European equity markets have been on a tear as well. It's slightly different in FX because it truly is a zero-sum game when you're talking about the different currency pairs. I want to talk about what could possibly replace the US dollar as a reserve currency, though, because I started here as a currency reporter back in 2016. And this was an article you wrote, I don't know, once a year. Are we seeing truly the end of the US dollar being the reserve currency? The answer was always no. But the reason why was because what is the alternative? What truly could be the alternative to the US dollar when it comes to reserve currency status? Because you look at some of the options and there's just a lot of reasons that point back to the greenback.
I think that's definitely the question of the year, I would say, and very topical. And absolutely, whenever people have tried to answer that question, what they have done is looked at the dollar's holdings at the central banks around the world. That actually has been shrinking and falling lower for the last decade, or in fact, more than a decade. But that to me was never the sign of the dollar's overvaluation or strength. It was always the strength and resilience of US assets and the massive investment of the global investors and money managers of the world purely in US equities. The dollar's overvaluation and safe haven status has, I think, gone one-on-one with US equity dominance a lot more than just, central banks holding dollar reserves, especially in the last few years. And that all is definitely starting to see, meaningful cracks. You're absolutely right in saying that, you cannot definitely point to one candidate currency. Euro comes close,
right?
But it's not a resounding yes that you can go out and declare that euro will be the next safe haven. It's definitely the next prime candidate, but at least you will bring everyone to a level playing field. It will be a much more level playing field than it has been.
All right, Jayati, great to get some time with you. That is Jayati Bharadwaj she is director of FX over at TD Securities. We're just getting started. This is Bloomberg.
In case you missed it, our latest Businessweek Daily podcast features Google's Cloud Yasmin Ahmed on how generative AI is impacting data scientists and developers. Download it now at Bloomberg.com or wherever you get your podcasts. Coming up on Bloomberg Businessweek, we're talking all things DC, a lot going on with Lisa Cook, and uncertainty around the economic picture after some eco data. This is Bloomberg.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We are looking at a down Friday, but despite today's losses, S&P 500 is set for its fourth straight month of gains. Also, expectations do remain that the Fed will cut rates twice this year, beginning as soon as next month, September. Traditionally a rocky month for the U.S. equity market right around the corner. Right now, we have got the S&P 500 index lower, tech leading the way down. S&P down 46 at 64.55. Now, keep in mind, this time yesterday we had the S&P trading above 6,500 at a record, but a pullback today down 0.7%. Dow Industrials at 45,502, down 0.3%, and NASDAQ down 1.2%. The NASDAQ 100 index down 1.3%, and the Mag 7 index down 1.3%. I mention that because Nvidia is down now by 3.7%. 10-year at 4.22%, with a 2-year 3.61%. Gold is up 0.8%, 34.43 the ounce. And West Texas Intermediate crude down 1%, 63.97 for a barrel of WTI. Bitcoin now at 108,225. Bitcoin now down by 3.3%. Caterpillar shares, they are trading lower today by 4.2%, only weeks after its last quarterly report. Caterpillar is warning investors it now expects tariffs to have an even greater impact on its business. Caterpillar down by 4.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you, Charlie. I'm Bailey Lipschultz alongside Katie Greifeld, filling in for Carol Masser and Tim Stenovec. Katie, a slow summer trading Friday. We've got markets lower, but volumes much depressed relative to where they have been in the last, call it, 100 days. But there is a lot going on in D.C. So right now we are joined by Bloomberg News White House editor Jordan Fabian, joining us from the D.C. Bureau. Jordan, we had an emergency court hearing around the kind of back and forth between Federal Reserve Governor Lisa Cook and President Donald Trump trying to fire her. What did we learn from that? It lasted more than 90 minutes, but we didn't have a ruling. What happened? What's going on? What's next?
That's right. No decision made in that hearing. The judge in that case wants filings again by Tuesday, so after Labor Day, and presumably they would want a decision on her job status after that, given we're in this period of limbo. Both sides, both the government and Lisa Cook's attorneys, argued vociferously about the case. What's interesting was that they didn't really say that the veracity of the allegations mattered. You had Lisa Cook's attorneys saying that whatever the allegations might be, they occurred before she was nominated to be on the Federal Reserve Board, and thus should not be seen as the cause to remove her from office. And then you had the government arguing, well, Donald Trump can decide whatever the cause is, and that's not up for judicial review. And so in his view, a simple allegation could be grounds to fire her, and that should not be for the court to decide. And so we'll see what the judge has to say about all of that.
Jordan, what I really want to know is what is going to happen on September 17th. That's when we get the next FOMC decision. We know that as a member of the Board of Governors, that Lisa Cook is a voting member, of course, of the Federal Open Markets Committee. Will she be able to do her job at next month's meeting?
That's the big question. And today they talked about whether there would be a temporary restraining order on this move by President Trump, or would there sort of be consideration of a longer injunction. And I think they tended toward the latter, given that longer injunction would provide more certainty over the course of months while this case plays out, Katie. And I think that they would want some sort of decision by the 17th, given that timing for the FOMC meeting.
Yeah, so that's a lot of uncertainty, Jordan. One thing that adds to the uncertainty and ongoing conversations happening in D.C. and their impact kind of around the world, we have a report that Samsung and SK Hynix now have 120 days until a waiver expires as the administration pushes to revoke their ability to ship equipment to China. What's the latest on that? Is this just another headline that kind of causes a bit of confusion and uncertainty, but still has quite a bit of ways to play out?
Yeah, I think that's right, Bailey. This is not going to have the biggest material impact on those companies, given they don't have huge manufacturing presences in China. But it is another lever for the Trump administration to use in this longer trade battle they've been in with Beijing. If you'll remember, ahead of that trade truce, they were ratcheting up tariffs on each other. They were imposing export controls, and some of those controls that were imposed were lifted in exchange for tariff reductions. So this could be, the next point of leverage for President Trump ahead of another meeting between the U.S. and Chinese delegations. Now, we don't know when that will be, but the 90-day truce comes up in November. So we're not, the administration says this is about leveling the playing field for American companies compared to foreign competitors. But of course, there's geopolitics at play as well.
Well, Jordan, this story caught my eye because it's just another example of the fact that it seems like the semiconductor industry is the arena where you see a lot of these U.S.-China trade tensions are actually being played out. You have this story today. You think about what's going on with NVIDIA, the question marks over whether or not it can sell its chips in China, and then the U.S. stake in Intel. It just seems like a lot of this is being funneled through these chip companies.
Absolutely. A lot of uncertainty there. And, for good reason, the administration, views the semiconductor industry as perhaps the crucial, national security relevant industry, given the U.S. ambition on AI and their desire to outcompete China in that area. So they want to do everything they can to, wall that off from Chinese competition. But it is creating all this uncertainty. And I will also mention, in addition to all those things you mentioned, Katie, there is the upcoming semiconductor Section 232 tariff that is yet to be announced. Trump has said there would be some kind of exemptions for companies that are manufacturing in the United States, but we don't know yet what that's going to look like. So that's more uncertainty on top of all those other things that these executives have to contend with.
All right, Jordan, really appreciate that update. That, of course, is Jordan Fabian. He is a Bloomberg News White House editor, bringing us the latest from D.C. Let's talk about these markets a little bit more, because you take a look at the S&P 500. As we mentioned 24 hours ago, we were feeling pretty great at all-time highs, even with NVIDIA lower. It's a different story today, Bailey. Of course, selling off into the month-end close. It's interesting to see this drawdown, given that we didn't get bad news on inflation this morning, bang in line across most measures.
No, and it wasn't terrible, but we still, KDR, in a market that we hit an all-time high yesterday. So the question comes to traders on the desk who are actually kind of operating in skeleton crews. No reason to be long through the holiday weekend. So why not take some chips off the table? But as you mentioned, looking at those factors to watch, momentum and growth underperforming quite a bit, while dividend yield and low vol stocks outperforming.
Yeah, certainly a risk-off picture then. Those are your outperformers today. But as Bailey notes, you take a look at trading volume right now. We are 21%, the 30-day average for trading volume when it comes to the S&P 500. But one area that we're paying attention to is what's going on with shares of Fannie Mae and Freddie Mac. So let's bring in Norah Mulinda right now. She's a Bloomberg News equity reporter. And it was interesting, Norah, to see Senate Democrats, including Elizabeth Warren, Chuck Schumer, and Cory Booker, trying to pause the Trump administration's plan to IPO these companies. But how much weight do they actually have in this process?
Absolutely, Katie. I mean, of course, we know this has been a very closely watched story for Fannie and Freddie, who we know were taken into government conservatorship back in about 2008 after they were taking on way too much debt, riskier assets there in particular. But what's really interesting today is, as you pointed out, the letter that we did see from Senate Democrats, Elizabeth Warren, Chuck Schumer, Cory Booker. They're all sending a letter to Bill Pulte, who we know is the head of the FHFA. They're the ones that control and oversee Fannie and Freddie. They sent a letter to Bill Pulte essentially saying that we need to hit a pause. We need to halt this idea of pushing these companies toward an IPO and returning to public markets instead of trading particularly as over-the-counter stocks here. They're saying that Pulte and the Trump administration more broadly should actually be focusing on other different initiatives to bringing down the cost of houses in the United States. They're saying that the administration is really distracted with attacks on the Federal Reserve and all these other things, where they should really be thinking about what we could be doing with what we have access to do right now, instead of spending too much time on the idea of an initial public offering for these companies.
And Norah, you keep a close eye on these stocks. They started out in the red at the open, but right now they're a little bit higher. What does that mean in your view for kind of the projection that this could be an IPO that really does move pretty quickly this fall?
Right. And as you well know, Bailey, I know you cover IPOs very closely on our team as well. I mean, these are super volatile stocks. So as you mentioned, we did see them earlier in the red right off of the news about the letter being sent to Pulte. But now we're seeing them popping into the green. And if you look on a larger scale here, looking year to date, Fannie Mae shares are up about 244% year to date. Freddie Mac up about 192% so far this year. So, I mean, we really have seen a rally off of the idea that after Trump was elected, maybe under a Republican administration, we could see some progress here as it relates to taking Fannie and Freddie through an IPO here. But I mean, it tends to be a very volatile trade here, especially with some heavy hitters, particularly Bill Ackman here on the trade.
Yeah, Norah, when you talk to your sources, what's their view on the legitimacy of an IPO of Fannie and Freddie potentially combined, and how does that impact the entire real estate sector that you cover closely?
I think that's part of what is also getting a lot of the attention. I mean, as I've been speaking to sources, this is a really complicated process here, especially because we know that these were companies that used to trade on a major exchange, and of course now they're trading under pink sheets here. But as we bring them back into this idea of potentially bringing them in as an IPO, it's really a complicated process. I mean, there's a lot of intricacies that are needed. It sounds that, Trump's approval is actually going to be something that's super essential in getting this done. But we did see PIMCO even warning that a potential Fannie and Freddie IPO here could essentially roil the MBS market, also just lifting mortgage rates. That's really been a concern that I've been hearing from my sources more broadly.
All right, Norah, really appreciate your reporting here as we continue to follow this story. That is Bloomberg News equities reporter Norah Mulinda. And Bailey, I have to put on my Matt Miller hat because I can hear him in my head saying, why are we calling this an IPO? These are already listed companies. This is a secondary offering, isn't it?
Well, these are already listed companies, but they trade over the counter. They trade kind of more as a call option, if you will, to oversimplify the matter. So if there were to be a real listing of these companies potentially combined, that would be a first-time share sale. That's why we'd call it an IPO.
All right. Well, I'm not actually Matt Miller, so I'm going to accept that explanation and say, fine, that makes perfect sense. I will continue to call it an IPO. And I'm glad you asked about the effect this would have on the housing market, because there are concerns that if we did see this IPO, that we could see some pressure on mortgage rates, actually, which would have the opposite effect of what I believe the Trump administration is trying to do, and that is lower the cost of home ownership in this country.
Well, they want to do a lot to kind of juice the wheels, if you will, of getting people to buy and sell homes. As a new homeowner myself, I can say that the interest rates are pretty eye-popping and hurt the wallet. The big thing, though, Katie, is what does this actually mean? If you do take these companies public, will the kind of benefit of publicly operated companies actually care about profit over people?
Yeah.
And that's a big question. And obviously the Trump administration's been pushing this, but the uncertainty around how this comes to be is top of mind.
Yeah, how you actually execute this. There's a lot of urgent questions there. So we'll continue to follow that on Bloomberg Businessweek. And coming up, we're going to head down to Florida. The National Bank of Florida Vice Chairman and CEO Jorge Gonzalez joins us. And then we're also going to check in at Arthur Ashe Stadium with Tim Stenovec and Molly Smith. All of that and more coming up. Don't go anywhere. This is Bloomberg Businessweek.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. 1 hour, 20 minutes to go until we wrap up the trading month of August. It is on to the often rocky month of September. We have got stocks lower across the board right now. Tech shares selling off. Let's begin with NASDAQ and the NASDAQ 100 index right now. The NASDAQ Composite Index down 1.2%, down 265. The NASDAQ 100 index down 1.3%, keeping it all in context. We got the S&P down 45. Yesterday, you recall, we were trading above. Indeed, we closed above 6,500. 64.57 right now on the S&P. That is a drop of 0.7%. The Dow down 117, down 0.3%. The Russell 2000 index of small cap shares is down 0.7%. Our Mag 7 index down 1.4%. Nvidia, big part of that index, down 3.5%. 10-year, 4.22%, with a 2-year, 3.61%. Gold is up up $27 the ounce at $34.44, up now by 0.8%. A retreat for crude just above $64 a barrel, down 0.9%. And a sell-off for Bitcoin down 3.4%, now at 108,152 on Bitcoin. Earnings news: Petco Health and Wellness surging after raising its earnings target for the year as the company's turnaround starts showing signs of progress. Shares of Petco, which uses the ticker WOOF, woof, up 22% right now. Gap after earnings higher by 1.1%. After earnings, Ulta Beauty down by 6.7%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you very much, Charlie Pellet. I'm Bailey Lipschultz alongside Katie Greifeld, filling in for Carol Masser and Tim Stenovec. We had some economic data this morning, which painted a mixed picture for the consumer. Inflation remaining sticky, but consumers just keep on spending. To discuss that from a state level, we're now joined from Miami by Jorge Gonzalez. He is the City National Bank of Florida Vice Chairman and CEO. Jorge, I always find that banks have some of the best reads into the state of the consumer. What are you seeing from your customers in Florida? Is spending still continuing to go strong? Are people dipping into their savings accounts? What's going on?
Well, first of all, thanks for having me today, and happy Friday. Listen, what we're seeing from our clients is just a complete commitment to investment in the state of Florida for long term. We're continuing to see a lot of migration into the state of Florida. New business starts continue to trend upward. So spending is something that the consumer continues to be positive and optimistic about, and we're not seeing any pullbacks.
Yeah, no, that's interesting. And you could say the same about the economic data as well. So interesting to hear the read from where you're sitting as well. It's interesting when you think about the financial sector, particularly the regional banks. There's a lot of talk about consolidation there, and we have seen some pickup in M&A, but certainly not to the degree that maybe some were calling for. Is that something that you would expect potentially in your future as well?
There's been a lot of consolidation in the state of Florida from a banking standpoint. Over the last 20 years or so, we've gone from over 300 banks to under 100 banks and probably under 80 banks today. I think as the new administration takes a new look at regulation and overall the economy continues to settle down, you'll probably see a lot more M&A activity. And for now, though, we haven't seen a lot. I mean, there's been a lot of conversations, there's been a lot of discussion. We've done 2 transactions in the last 5 or 6 years. We're always opportunistically looking for something that makes strategic sense. But for right now, I think everybody's just kind of waiting to see how the economy, how this soft landing plays out, how asset quality continues to perform, and how rates go before anybody makes any real significant decisions on the M&A front.
Well, to follow up on a point you made, I mean, you think about Florida, you think about Miami in particular. I mean, it is hot. You've seen a lot of, I mean, literally when it comes to temperature, but also in terms of people moving to Florida, a lot of folks relocating there, as well as companies. I know that you've spoken in past earnings calls about the increased competition that you're seeing when it comes to deposits. Give us an update on that.
So, Florida continues to be one of the best performing economies in the entire state of Florida. Our GDP is up about 26% since 2019. I think there's been over 3.6 million new businesses have been launched over the last 4 or 5 years. I think the really main driver to what's happening that's really different than what's happened in the past is that in addition to a lot of international capital coming into the state of Florida, we've seen a significant amount of domestic flow of investment that's not coming here from a transient standpoint. It's coming here from a long-term perspective. And that's really changed the economic foundation of the state of Florida for the long run. So from that standpoint, what you would expect to see, since there's been so much capital and investment flowing into the state, you're also seeing increased competition from other banks following those clients into the state of Florida. So I think the pie is bigger for everybody, but certainly the economy has seen a very nice ramp up and really created a new foundation for the future that we're very optimistic about.
And Jorge, we talked a lot about Wall Street South over the last few years. How is that continuing to play out? Are we still seeing commercial real estate performing strong, or is that slowing down?
Listen, commercial real estate has been a peak and valley business in the state of Florida for a long time. And I think because of the changing foundation of the economic landscape, I think what you're going to see, the peaks and valleys are going to be much more subdued. We're seeing a lot less leverage into a lot of the commercial real estate asset classes. So across every asset class, whether it's office, multifamily, retail, industrial, you name it. What you're seeing is really long-term capital that's been deployed. And therefore, there's a lot of stability in the marketplace. So when you couple the migration, the very pro-business government that we have in the state of Florida, the immigration of capital from the deployment of capital from international and domestic sources, and immigration of many hundreds of thousands of people, really it's helped stabilize the real estate market across the board, and prices are holding, rents are holding. Even the office sector, which has been weak across the country, has performed relatively well in the state of Florida, and certainly in South Florida.
I'm also curious, George, to get your perspective on what a weakened dollar would mean for you. We were having a great conversation earlier with Jayati Bharadwaj of TD Securities. Their expectation, their house view is that we're going to see continued weakness when it comes to the U.S. dollar. I know that you see a lot of cross-border activity from where you're sitting. What would that mean for you?
Listen, a weaker dollar, I think, also tends to spur more investment into the state of Florida as assets become a little bit more, prices become a little bit more attainable for outside investment. So from that standpoint, I think the weak dollar is not going to have a significant impact to the Florida economy. I think the other thing to talk about, too, is what's happening relative to the overall global visibility of this market. And the reason we're seeing so much global visibility, in all honesty, is what's happening in the world of sports in the state of Florida. I was thinking about this before the conversation, before this interview. When I was growing up, South Florida, state of Florida, basically had it was a one sport state really around football. When you think about what's going on in Miami today, we got 5 professional franchises. We have Formula One Grand Prix. We have a Miami Open tennis tournament. We have FIFA World Cup, which is generating probably about $1 billion worth of investment into the state of Florida. We have the Orange Bowl game. We have the national championship game. And then we have a Super Bowl in 2027. Sports is big business, and sports is a big economic driver to our economy. I think it's going to represent about 10% of our GDP for 25 and 26. So not only is it a big economic driver, but it's a big driver to branding and visibility for the state and for the economy. So when you couple that with what's happened in the last 5 years and what's happening in the world of sports, I think the combination of that really bodes very well for continued growth, continued immigration. People want to be here because they like what's happening, not just from an economic standpoint, from a government standpoint, but also from a sports standpoint.
Yeah, George, you go straight to sports. You've got the University of Miami logo behind you. Mario Cristobal talking about spending big in NIL. Miami goes out and gets Carson Beck from the University of Georgia. We've got a big game tomorrow. Notre Dame coming to town.
This is a big football weekend. I love college football. This is we got 3 big games this weekend with basically you got Texas, Ohio State, you got Florida, you got Clemson and LSU. And then you got Miami, Notre Dame kind of tapping off the weekend on Sunday night. 2 top 10 teams, a lot of history there between these 2 franchises. And, we are the official bank of the University of Miami. We're obviously rooting for the Canes. But it's good for sports all the way around. This is a high visibility game with a high level of impact. And we think it's just a kickoff to a great season relative to what is in store for us relative to all of our professional franchises. And we decided to partner up with the University of Miami because this is an institution that has been around for over 100 years. It's really the civic pillar of our community. It's one of the economic drivers of this community. We've been around for 80 years. They've been around for 100 years. We have the same core values of giving back to the community, supporting, the next generation of leaders and innovators, and making sure that this community continues to be robust relative to all of the important pillars that are needed to have a healthy community. So we decided to become the official bank of the university and support not just the athletics, but support the health system, the law school, the faculty, the students, the alumni. And it's really been it started off to be a great partnership. And we're doing the same thing in Orlando, one of our key markets. We're also the official bank of the Orlando Magic. And that's an organization that really is one of the marquee brands in the city of Orlando. And great front office, great ownership, great players, great fan base. And we've realized that when we partner up with organizations like the U and like the Orlando Magic, it really does great things for our brand, our visibility, and it allows us to activate those partnerships in a way that we provide our clients access to things that they can't buy with just money. And it's proven to be very successful partnerships on both ends.
All right, George. Well, we really appreciate you taking some time for us. Enjoy the game this weekend. That is George Gonzalez. He is City National Bank of Florida Vice Chairman and CEO. I'm Katie Greifeld, along with Bailey Lipschultz, of course, keeping the studio warm because Businessweek's Tim Stenovec and Bloomberg News economics editor Molly Smith are on the ground in the shadow of Arthur Ashe Stadium. They join us now for a preview of what's ahead for the Bloomberg audience this afternoon at the U.S. Open. Guys, what do you have coming up?
We got a great program, day 2 for us here at the U.S. Open. It's the third round for the men and women. And actually today, Molly and I got a little bit of a chance to go see some tennis. You know, we got to do the prep work in order to be ready for this program. I went and saw a great match, 4-setter between Benjamin Bonzi and Arthur Rinderknecht, both French guys. They battled it out in 4 sets on court 17. A really strong baseline game from both of them. Some incredible rallies. What'd you watch?
Yeah, that was a good one to watch. You picked a good court there, Tim. I was really into the doubles today, so I went out to watch the top-seeded doubles team on the men's side. That draw started today. They actually lost. This was a pretty big upset with the team featuring an American guy, so the crowd was really loud. It was super fun. Just great to see doubles. That's what I play year-round, and it was a good learning lesson for me. A lot of lessons.
Maybe next year you'll be on the court. Maybe next year.
Maybe. Yeah.
Well, it's us. We're back here today with 70,000 of our closest friends at the U.S. Open. And we got a great program coming up over the next couple of hours, too. Kirsten Corio is going to be joining us. She's Chief Commercial Officer at the U.S. Tennis Association, the USTA. It's the owner and operator of the U.S. Open. So we're talking everything with her, from just how the whole tournament is doing to increasing visibility, taking it on the road, perhaps, extending the tournament. All that and more coming up. Also, a little later, we're going to make sure we stick with everything happening over in Manhattan and also down in Washington, D.C. Mike McKee is going to be joining us for the latest on everything eco and, of course, everything happening with Fed Governor Lisa Cook with that hearing today, wrapping up with no decision at this point. So we're doing tennis, we're doing economic data, we're doing it all from the U.S. Open, guys.
All right, you're also watching tennis, so I hope you have a wonderful Friday. Yeah. Looking forward to the program. That, of course, is Tim Stenovec and Molly Smith. You can catch them in just a couple of minutes. But, Bailey, you actually have to skedaddle off because coming up on Bloomberg TV at 3 p.m., you're going to be live with Scarlet Fu.
Someone's letting me hang out with Scarlet, and it's going to be fun. We're going to talk about the markets underperforming. Obviously, a lot going on in D.C., as Tim Stenovec mentioned, and have an interview with the Celsius CEO. So a lot of exciting times.
All right. Make sure you drink a Celsius beforehand. But, you know, there's a lot more to cover here on Bloomberg Business Week. Let's take a look now at some stocks on the move today. I'm Katie Greifeld, and we're joined by managing editor for Bloomberg Markets Live blog, Kristine Aquino. Kristine, what do you have an eye on?
Well, Katie, I'm taking a look at Kraft Heinz this afternoon. We did have some breaking news from the Wall Street Journal. So Kraft Heinz, ticker KHC, we're seeing those shares actually picking up some momentum, up 1.2% at the moment. And that is because Wall Street Journal reported that it is closing in on a plan to break itself up, according to sources. So remember, we did get reports earlier in July. Bloomberg News reported that there was a plan being put into place to break up the company, and they were weighing whether to spin off a large part of its grocery business into a new entity. So the latest from the Journal is that that transaction could be finalized and announced as early as next week. But of course, with any M&A deal, we know that it could still be subject to change, and timing could still be different at the last minute, but that is the reporting at the moment. And investors seeming to like this because year to date, that share is down 9%, nearly 9%. So it's really been having a hard time.
Yeah, and it's an interesting space right now. So you have Kraft Heinz trying to break themselves up. Then you think about some of the other deals that we learned about this week. Keurig Dr. Pepper going to buy JDE Peet's. So companies breaking themselves apart and also combining. So a little update there on what's going on with Kraft Heinz. What's going on with shares of Dell, though?
Dell is not doing well today, guys. It's down more than 9%. So ticker DELL, really extending those declines heading into the close here before Labor Day weekend. And that's because we did get its earnings report. The latest there is that the AI server orders slowed down in the second quarter. Did see a 5.6 billion figure there versus 12.1 billion in the previous period. So that's quite the slowdown. Operating margin also undershooting estimates. Analysts were expecting 10% 10.3%. They only reported 8.8%. The silver lining, though, is that it did boost its annual outlook and quarterly sales and profits topped estimates. So JP Morgan taking a look at those AI server revenues, they're thinking that, there's a more robust outlook for the fiscal 2026, and that could raise expectations for growth medium term. But in the short term, shares are down and investors are not happy.
Yeah, down 9%. Really brutal reaction there from Wall Street, especially considering that this is a company that raised its annual sales projections. But of course, that is not where the focus is today, just judging by the shares. So that's the story with Dell. Bring us home. Talk to us about Caterpillar.
Caterpillar, ticker CAT, also not doing well. Shares down more than 4% and looks like it's going to close down for the first time in 3 sessions today. Now, Caterpillar warning, of course, all about tariffs, and they're saying that tariffs are going to cost them as much as $1.8 billion for the full year. And then the incremental impact for the third quarter, they're estimating at around $500 to $600 million. And so that does not sound like a good thing, especially for a company that was once considered a bellwether for the American economy, right?
Yeah.
And, Bloomberg Intelligence saying, though, that they are still optimistic that earnings will bottom this year and that obviously the drag from tariffs is bigger than anticipated previously, but they did revise this revised outlook will impact operating margin, and they're not expecting that to be near the bottom of its target range.
All right, so an ugly finish to the week, to the month for Caterpillar. And for more conversations like this, listen to our new Stock Movers podcast. Subscribe for 5-minute episodes on the biggest winners and losers in the stock market. You can listen to Stock Movers on Apple, Spotify, or anywhere you get your podcasts. Meanwhile, outside of just the individual stock level, Kristine, before I let you leave the studio, let's just talk about what's going on today. I'm sure you've been all over it on the Markets Live blog, the fact that you are seeing quite a risk-off day in markets, even though, the inflation figures we got this morning would suggest that we're on track for a rate cut next month.
Yeah, absolutely, Katie. But it seems like the data is kind of playing second fiddle to other factors in the markets, right? This week was the week where we did get those big NVIDIA results. That was also one main event for markets, and some disappointment there just over the pace of growth that they're seeing over the next few years. It seems like the reality check really that gave a lot of investors that, the AI boom is starting to slow. It's entering its more mature stages here. And that's really hit NVIDIA. It's also hit a big chunk of the tech stock complex here and really taking us into quite a dour finish into the Labor Day weekend here.
Yeah, it does look like we're going to close out August with gains, but certainly quite an ugly finish, though a lot can happen in the next hour with those month-end window dressings. That is Kristine Aquino. She is managing editor for our Markets Live blog. If you're watching us on YouTube or listening to us on radio, Bloomberg Businessweek Daily continues live from the U.S. Open with Tim Stenovec and Molly Smith. If you're with us on Bloomberg Television, the close is up next with Scarlet Fu and Bailey Lipschultz. This is Bloomberg.